Welcome to Trading Day. I'm Roger Peterson. Thank you very much for joining us. Let's get to some of the stories now that we are following in the BNN Bloomberg newsroom. Warner Brothers Discovery shareholders have voted overwhelmingly in favor of a merger with Paramount Skydance, despite widespread opposition to the deal in Hollywood. Paramount will buy Warner Brothers for $110 billion, beating out Netflix after a months-long bidding war. The deal is still facing antitrust reviews in several jurisdictions, including the U.S. and the EU. If regulators end up blocking the deal, Paramount will have to pay a $7 billion termination fee. The U.S. Justice Department has reclassified state-regulated marijuana as a less dangerous drug. The directive moves licensed cannabis products from Schedule I to the less strictly controlled Schedule III. The move stops short of fully legalizing the drug for recreational use nationwide, but it meets the demands of many advocates who have long argued for looser restrictions. Shares of Lululemon are falling after the company announced former Nike executive Heidi O'Neill will take over as CEO. O'Neill spent more than 20 years at Nike and is set to step into the role in September. She takes over at a tough time with weak sales, rising competition, and a recent sizing controversy. Lululemon shares are down more than 35% in the past year. And taking a quick look at the markets, and the TSX flat right now. It's been hovering right around the break-even mark. Industrials, though, having a decent day, up 2.5%, but going the other way, dragging everything down. Healthcare and tech, they are off by 3.5% to nearly 4%. South of the border, and similar situation, they're off now. It's been all over the place. We saw some green earlier. Now you can see the S&P 500 down by 1/4, the Dow by about 1/3, and the Nasdaq by about 0.5 point. As geopolitical tensions continue, we are looking at where oil prices might ultimately settle once the conflict eases. Joining us now to discuss that and more is Jerome Haas, partner at Lightwater. And Jerome, thanks very much for joining us. It is, it's another day, isn't it? With where are we going, what are we doing, and how are we doing it, I think.
Yeah, it's interesting when we're watching the screens. If all of a sudden we see a move in the market, we know President Trump has put out a tweet of some sort. So there's usually something to keep our attention during the day. But yeah, it really is watching the events in the Straits of Hormuz. It's really what we're focused on these days, and I think it has profound implications for the overall market too.
Now, the market, though, has surged over the last 2 weeks. The Nasdaq, I think, is up close to 13%, did I see at one point? Are we pricing in that there's going to be a solution sooner rather than later?
Yeah, I'm very surprised that we are at all-time highs on markets, and even President Trump commented on it the other day. He said he was surprised that oil was only at $90, and he was surprised the markets weren't down 20%. I think for once he was spot on with one of his observations. I don't really understand why the market's not reacting as they are, but that's the way it is.
That's the way it is. And with the oil, we're still seeing prices that are high. I mean, they're definitely high, but they're not as high as I think what some people thought it could be. And so I guess the question is it going to stay here? Or if it drops, will it drop back to where we were pre-war? Or is there a new low coming?
Well, I think prior to the events in February in Iran, people would have used a bottom of about $60 for WTI, probably an average of about $65 for this year, largely because President Trump needs to get the price of oil down for the November midterms. But as a result of the events in Iran, I think you got to add at least $10, if not $15 to that. So you're looking at $70, $75 as a bottom. So we do have, when the bombs stop falling, it will come back, but it'll probably be, we're guessing, around the $75 level for WTI, which is still very attractive from Western Canada's perspective.
I was going to say, I mean, is this an opportunity for Western Canada? I mean, those are numbers that make the oil there look tempting, aren't they?
It is. There's some bargains out there, but it's kind of a tricky situation for investors because the day that there's some announcement, you'll see a very big drop. So I think it was last Friday we saw a 10% move in WTI. Stocks didn't react as much because they haven't risen as much as WTI is, but for sure there will be an impact in that. So it's kind of a tricky situation for investors to be in.
And one of the companies out there, the Mullen Group, just had their first quarter and had a beat.
Yeah, I would describe them more in line, but certainly by the reaction in the stock market today, I think the share prices were up 4 or 5% this morning. I'm not sure how they're holding in right now. But I think it was more a factor of the comments that came from management. So I think their revenues were up about 10%, which is good numbers, but that was largely in the back of acquisitions. If you look at the organic growth of the company, it was actually negative organic growth, which not surprising for a trucking company. But the reason why there was the positive response is that management indicate that we're finally going to get to an end for what they describe as the freight recession in Canada. They had a very good March, and so the market's very optimistic that will carry forward. As well, I think there was commentary about their pipe hauling business and the potential for some pipeline business in Canada if we get a pipeline built to Western Canada. I don't share the market's enthusiasm for that prospect, but judging by the 5% move today, apparently the market does. And as well, there's some talk about them doing some work for LNG in the States. So again, that's more for the pipe hauling business.
All right, let's get a couple of ideas you're liking right now. Total Energy Services, TOT.
Yeah, this is a diversified energy services company. They're in the drilling, retail, compression, and well services verticals. So they're a fairly diversified energy services company. It's run by a guy named Dan Halleck, who's a lawyer out of Saskatchewan. The company's based in Calgary. And, there's only one analyst left covering it on the street, but he's looking for 15% EBITDA growth this year, which we think is pretty impressive. At the same time, the stock's only trading at about 3.6 times EV to EBITDA for this year, which we think is very cheap. And for a company that's got a rock solid balance sheet, has no debt, it's got about a 2.5% or 2.2% dividend yield. We just think it's a great place for people to park their money, and they will benefit from the higher oil prices as well in Western Canada.
All right, and the other one I want to get to before we run out of time, Surge Energy.
Yeah, Surge is about a 23,000 barrel producer in Western Canada, primarily focused on Sparky and Southeast Saskatchewan. They've had fantastic drill results over the last few quarters. They consistently have 3 or 4 names amongst the top 10 wells drilled in Western Canada. So we think it's a very good story in that. They've got about 12 years worth of inventory. They're very sensitive to the oil price, so they are a beneficiary of the higher oil price in Western Canada. And as a result of the move, if you look at strip pricing, it's trading at less than 3 times cash flow, which we think is very attractive relative to some of its larger peers, which are trading at twice those multiples. So I think people could do not a bad place to park your capital as well, and it has a high yield. I think it's about a 6% yield on it still.
Any concern about the sensitivity to the prices, though, the oil prices?
Yeah, no, oil prices come down, Surge, and there's a couple other names out there will clearly be affected in that. But the good thing about the mid caps is they have the ability to hedge, and they are hedging. So yeah, they will produce free cash flow from these higher prices.
Okay, we've got to wrap it up there, Jerome. But thanks as always for joining us.
Thanks for having me.
Jerome Haas is partner at Lightwater Partners. Up next, Tesla shares are down today despite the company's first quarter earnings beat. Find out what's contributing to the negative sentiment after the break. Tesla shares are down today, despite reporting first quarter earnings that exceeded analyst estimates. The company's increased capital expenditures is what is raising concerns among investors. However, our next guest believes the spending is necessary to support Elon Musk's AI ambitions. Let's bring in Tesla bull Dan Ives, global head of tech research at Wedbush Securities. Dan, thanks as always for joining us. He needs this to take over the world, doesn't he?
As an understatement. Look, the reality is they're a physical AI play. I mean, this is the build out of autonomous and robotics. That's really the future of Tesla. Look, it's step by step. You saw the increase in CapEx. Investors, didn't really love it. But it's my view, this is just further steps to ultimately what will be a merger between Tesla and SpaceX next year.
And do you like where the money is going, or the plans for the money, the tax, the X amount of the tax? I'm just trying to see some of the numbers here. Do you like how he's spending it? Or I should say, Tesla's spending it.
That's the future. You don't want to see it spent on automobiles, in terms of you will have some new models come out, but the reality is you want 90% of that CapEx spent on autonomous, the AI future at Tesla. Look, that is the growth. That's how you have an incremental 1-2 trillion in terms of what we view as value. I think in terms of physical AI, the two best physical AI plays in the world are NVIDIA and Tesla.
And is there a concern at all that people may think that he's forgetting about the cars themselves and is focusing too much on AI and the robotics?
Look, there's definitely that concern. I think you see it kind of in the stock and maybe some of the patience as investors. They want to see better free cash flow. You want to see better growth. The reality is that the EV business has been under pressure, but the future, it's about AI. I mean, it's no different than from Microsoft to NVIDIA to Palantir. I mean, this is an arms race playing out. When it comes to physical AI, that's how Musk and Tesla are really going about this, which I continue to think that's good money after good.
And I mean, with the cars, with the segment, revenue increased by 16%, considering all things considered. The EV tax credits expired. Musk took some hits over the dealings with Trump. What's getting people to come back to it?
I think part of that is just like you were saying, very depressed over the last year. You're seeing definitely some bounce back, some price cuts. You've seen China and Europe show some signs of strength. But the reality, look, and we see this for Ford, GM, really across the board. It's been softer for EVs. But if they crushed EV deliveries, the stock is not moving significantly more than here. The reality is what I believe 600 is a base case price target, 800 is a bull case. It's all going to be driven by AI, autonomous, robotaxis, cybercab launches. In my opinion, if you have a 8-year-old today, when they're 16, they're not going to need a driver's license given autonomous.
I know, I'm kind of sad about that. I won't lie. Could you see Tesla moving out of autos entirely and just having no, I guess I'll call the software, the AI capabilities, and selling that to different brands?
Look, I think they're always going to have autos because that's the data. You talk about 10 million vehicles on the road. The data is ultimately what drives that. So that's always going to be a core part, just like iPhones are always going to be a core part for Apple. But when it comes to the future, it's about autonomous. It's about robotics. It's about full self-driving. That is the golden goose for Musk and Tesla.
And how much of a threat then are Chinese EVs?
Oh, they're a threat. I mean, in China, if you look BYD, you look at domestic competition, Xpeng and others, and I've seen it firsthand. I mean, it's super impressive, and that's been a competitive headwind. But also it speaks to, for Tesla, when you think about autonomous, it's not just in the U.S., it's global, including in China. And they need to make sure that they sort of hold serve when it comes to what's happened in the China market.
Now, one other segment, energy underperformed this quarter. Is that the Trump administration's position on clean energy? Is that creating some challenges, or were there other issues?
I think definitely some issues there, as well as just overall in terms of regulatory, that continues to be one of the headwinds. But I don't think that's moved the needle too much. But I think longer term, that is a growth driver for Tesla.
And what were some of the issues?
I think some of the issues are just really around demand. It's around timing. It's around what we see in terms of in the U.S. I think the regulatory framework continues to be, I think, very confusing, and it's delayed some of the, capabilities that Tesla ultimately is trying to bring to the market.
And with the earnings call, you were in on it. Was Musk any concerns about delaying the timeline targets for the self-driving vehicles and the Optimus robot initiatives?
Yeah, look, that continues to be something that, I probably maybe delayed, call it 3-6 months, but he needs to make sure step by step that that's safe. They're very, very cautious in terms of building it out. And I think some investors might not like it, but that's what they need to do in terms of building out what's going to be the future of robotaxis and autonomous. And look, today only 15% of Tesla drivers have FSD.
Any concerns about being cautious, about them being too cautious, though, maybe missing out? Oh, I think we just lost Dan. There's technology. We should have done this interview in a Tesla, maybe. Okay, we lost Dan Ives, Global Head of Tech Research at Wedbush Securities. But we'll have more coming up after the break. IBM has beat expectations in Q1, but the stock has taken quite the hit. We'll find out why when we come back. You're watching shares of Lululemon as the company names a former Nike executive as its next CEO. The move is supposed to help weather a turbulent period of slowing growth. However, this decision seems to leave investors unimpressed. We've got more on this story from Poonam Goyal, senior analyst for U.S. retailing at Bloomberg Intelligence.
She's been at Nike for over 25 years, so has the expertise in the sports apparel domain. The thing is that she's never held the CEO's position, right? So there's a little concern around that. And then there's also some concern around the start date. If you think about where we are today in April, she's starting after September. So it's a long way there. And I guess the question is, what should we think about Lululemon over the next 5 months? Are things going to materially decelerate before we can see some, sign of light?
And has she left Nike, or will she be working with Nike until August or something like that?
It's unclear when she will leave Nike, so we don't know if she will be at Nike, through the summer, or whether she will depart Nike and will be taking a short break. That is still unclear, though it just means that the turnaround is pushed forward just longer, right? So now it becomes a 2027 transition year versus potentially could have been 2026.
I guess, though, it gives her some time to sit and think about what she wants to do with the company. It's had its share of challenges.
It definitely has, and Nike and Lululemon, while they do compete in the same sportswear industry, they are different, right? When you think about Nike, it's about a real focus on performance and sport. And while she did lead the women's division there, Lululemon is, I would say, sports with fashion combined. So it's somewhat of a different beast to tackle. And it'll be interesting to see what problems she kind of isolates out first and tackles first, and how she goes about it, because the competition has risen. It's risen from everywhere, whether it's Alo Yoga, whether it's the Nikes of the world or anywhere. How does Lululemon continue to set itself apart and really drive increased customer intent?
Poonam Goyal, senior analyst for U.S. retailing at Bloomberg Intelligence, was talking about Heidi O'Neill, the Nike executive taking over at Lululemon. All right, IBM has reported better than expected first quarter results, but shares are sliding as investors weigh ongoing uncertainty, particularly around how AI could affect the company's core business. For more now, we're joined by Ross Gerber, President and CEO of Gerber Kawasaki Wealth and Investment Management. Easy for me to say, I'm fighting a cold. I apologize for that one, Ross.
No worries.
How are you today, sir?
I'm pretty good, pretty good.
I think you're doing better than IBM, though. They're feeling on the software, aren't they?
Yeah, we own a little bit of IBM here at GK, and it's in my fund. And, we actually reduced our position, over the last couple of weeks. kind of worried about some of the issues that the market clearly is still worried about and why it's being sold off, which is, their consulting business. And it's such a big diversified company. And if just one area of their business is impacted negatively because of AI, it's really sort of bringing down the whole. So overall, they had great numbers, but there's just a lot of concern about the future of consulting and software. And I think it's legitimate.
You do think it's legitimate. So what is this the start of something then for IBM? Like that trend is going to continue downward, do you think?
Not necessarily, because the way IBM has their customer base is it's large enterprise businesses that really it's very difficult for them to switch providers. So I think it's really about, as companies transition to AI, I think IBM actually is in a good place to help their customers transition to AI and build the kind of hardware and security, which is, I think, ultimately what makes IBM interesting, is building something that's secure for large enterprises. Because, one of the things and risks of AI is AI hacking now. And that's the issue with Mythos and Anthropic. So, I think IBM will be fine in this, and it has had a little bit higher valuation than average recently. And so I don't look at this as, too much, but I also don't think IBM's the leader in AI. So that's the problem.
Yeah, and it is disconcerting when we see Mythos get hacked itself. I mean,
yeah.
And it didn't take
we're
much.
just at the beginning, I think, of a cybersecurity nightmare. So, we've been looking at cybersecurity for AI, like we own some CrowdStrike and we like this play, but boy, we're moving into a whole new level of risk, especially with a lot of antiquated software out there.
And with IBM, with their software unit, what would have convinced people that maybe things are okay? I mean, they meet estimates, right? They met estimates essentially in line, but that wasn't enough for people.
Well, it's kind of like the Netflix thing where you beat all your numbers and then you don't raise your guidance, and then you're punished like you've done something wrong because you don't want to set expectations too high. CEOs get no advantage setting expectations high. And so I call it the Tim Cook, Tim started this, where you just set the expectations low every quarter. Maybe you get hit for a day or two, but as you get into your earnings reports, down the next quarter, you're not misleading people, and then you can beat, and then you get the rally. So, it wouldn't surprise me to see IBM rally in the next earnings report after they report, or Netflix for that.
And was it people just staying away, or was it people looking at AI going, how can we incorporate this before we buy some IBM that we might need?
You mean regarding
the sales,
the company? Or
the sales. Buying,
no, sales were good. Sales are solid at IBM. They're all up, and we're talking double-digit growth at Red Hat, and this is a big company, so it's not Microsoft, but it's certainly doing quite well. And the stock market and company financials don't line up every day. Like a company could be doing well financially, and the stock price can move all around over the course of a quarter, for example. But I think when you look over time, that's how stocks gain value, is with rising earnings. So IBM reported a good quarter. Investors have a chance if they want to buy IBM. It's a cheaper stock now, right? But at the same respect, this isn't a stock I'm buying right now, and it's a hold at our firm. If not, I just reduce them, as I just said, and we own it. But it's not the name I'm most excited about by far, and I think there's a lot of risk. And a lot of the reason we own IBM is because of quantum computing as well.
Mm-hmm. Which is, how are they, where are they fitting in with quantum computing? Let's ask about that.
They're kind of the leader. A lot of people don't realize that Google and IBM are actually the leaders in developing quantum computing systems, as well as the fact that, IBM is kind of one of the creators of AI when you go back in history. So they were doing machine learning before anybody else. So IBM has a natural advantage. They're just not a very fast-moving, innovative company because they're so big and sort of that's their history. They're just not that fast-moving.
And would quantum computing be something that might take you out of the hold pattern?
I think it's a long-term thing, and my research in quantum, just briefly that I dove into it, I was like, okay, this is something that's going to take years to really develop. So I'm not too concerned about it. But what it is that they have this edge in their businesses through their experiences with quantum and AI, where they can really continue to develop. And because they manage, large mainframes and software and consulting, they really have a full stack solution for big companies that want to implement, technology. But I think it's mostly the risk that their technology is antiquated compared to the startups and the new companies that are coming around, pitching companies.
So you're waiting then to see the AI shakedown with it? Or may there be a moment that draws you in?
Well, I think, we originally bought IBM based off this premise that they are sort of the core original leader and a foundational company in databases and software and hardware. So, it would make sense for them to benefit in this era. I think it's about execution. And so we didn't dislike the quarter. I wasn't in love with the quarter either. But, I'm also not like selling the stock now. We sold off some, over the last couple weeks, actually to reinvest in Micron, which I think is a much more compelling name. So, that's part of the game too, is it as compelling as some of the other investments out there, and it's not. So that's why it's a smaller position for us.
Okay, we got to wrap it up there, Ross, but thanks very much for joining us.
Yeah, thank you.
Ross Gerber, President and CEO of Gerber Kawasaki Wealth and Investment Management. Coming up, we'll take a look at the crypto performance amid geopolitical tensions in the Middle East. That's after the break. Shares of Tech Resources are up after the company posted first quarter profit that more than doubled from a year ago. Miner also reported revenue that beat expectations, coming in at nearly $4 billion. The company says the strong quarter was driven by higher copper sales and solid operations. The results come as the company continues work on its previously announced deal with Anglo American. Shareholders have approved the transaction. Regulatory approval is still needed. Shares of Lockheed Martin are falling after the company missed profit estimates in the first quarter. The drop was driven by weak production performance, including delays on its F-16 fighter jet program and delivery delays on the C-130 transport aircraft. Despite those issues, the company reaffirmed its full-year 2026 outlook, pointing to new U.S. government contracts as a potential source of growth. Shares of Tesla are down despite the company posting a profit beat. The muted reaction comes as Tesla says capital spending will top $25 billion U.S. this year, well above expectations. The company is ramping up investment in AI, humanoid robotics, and the Cybercab platform. Elon Musk says the heavier spending is meant to set the stage for much larger vehicle production down the road. Despite being a bit flat today, crypto has seen a significant jump over the past few weeks. That move comes as tensions in the Middle East rise and oil prices climb. Bitcoin has continued to draw interest amid the ongoing geopolitical uncertainty. Joining us now to break this all down is Sean Bill, co-founder and CIO of BSTR. Sean, thanks very much for joining us.
Thanks for having me, Roger. Appreciate being here.
I mean, Bitcoin and crypto's always a roller coaster, been even more so one this year, hasn't it?
Oh, absolutely. Yeah, I mean, this is actually a relatively mild drawdown for Bitcoin this year, down about 40% from the peak. For those of us who have been in Bitcoin for a long time, this is relatively tame. We've seen some other declines into the 60s and 80s, even in the early days. So I think as this sector has grown and as the market cap of Bitcoin has expanded, we've actually seen the volatility come down quite a bit.
And are you surprised, considering with what's unfolded in the Middle East, that it hasn't been as volatile?
I think that a lot of folks view Bitcoin as almost like a digital gold. So it kind of makes sense to me that it's kind of finding a bottom here with all the activity going on in the Suez Canal and when the price action we've seen on gold, although it's been a little more volatile lately. Bitcoin's very similar. It basically functions a lot like gold. It's a limited supply. It's convertible into any currency in the world. And, those two functions are what make it like a digital gold that you can move in your wallet, that you carry on your phone.
And any concerns about broader macro issues with crypto right now?
Well, I think the one main issue would be what's going to happen with M2 money supply, and so what we're seeing here in the Middle East and with potentially higher energy prices and what have you could actually lead to higher rates. That would be probably a negative for Bitcoin. However, on the flip side of that, the U.S. government's going to have to replenish all those armaments that they've been spending in the Middle East, and that could lead to additional money supply growth. So if we see money supply growth, that usually is very positive for Bitcoin.
And with that Senate crypto bill that's working its way somewhere, I guess it's at the Senate
It's
at the Senate Banking Committee right now. It's on its way. How important is that, and is it shaping up to be something that will be good for cryptocurrency?
Well, we think it's really important, actually. The Genius Act went through, and that kind of laid the groundwork for stable coins. And this is important because under the prior administration, there was a kind of a negative tilt towards digital assets. And so we lost a lot of that industry to Singapore and Switzerland and other countries. And so what we've seen with the actions from Congress and the Senate is they're really trying to create an operating framework for folks to be able to operate, legally here in the U.S. And we think that's a really strong positive. I mean, we want to see the U.S. as the financial capital of the world. To do that, you have to update the regulation to fit today's modern age of digital assets.
Cryptos always seem like there's a bit of an outlaw feel to it. And will people come into the fold if that goes through?
Yeah, so I think, back in 2019, I originally proposed adding Bitcoin to our pension funds here in California when I was the chief investment officer at Santa Clara. And, back then people looked at you like you had three heads, like what you're crazy, right? But this asset actually has a very low correlation to other assets. It has a strong fat right tail in terms of the return distribution. And so it actually makes a lot of sense for endowments, foundations, pension funds to have a smidge of Bitcoin in their portfolio. And we've seen broader adoption now. It used to just be, the Virginia Fairfax folks, the Houston firefighters and Santa Clara that were really had any exposure. But now you're seeing it be a relatively hot topic within the pension community and within the endowments and foundations who are probably one or two steps ahead of the pensions. Most of those do have some exposure to Bitcoin.
And I'm just seeing the story about Satsuma, the Bitcoin accumulator, and shareholders now pushing for it to sell all the tokens and wind down. Is that a concern, or is that a one-off, do you feel?
I think that's potentially a one-off, but I mean, if you're, I think that this is a game where you're going to have, just like, I guess if we step back and we think about technology and, zero net marginal cost for each additional unit that you're investing and trading in, generally these models tend to consolidate with large players. And so that's our view. We think that there will be a couple of large winners in the Bitcoin space. Bitcoin Standard Treasury, our company, we think will be one of those winners. So it would be the second largest Bitcoin treasury likely when it comes public in June. And just like you have, one or two winners in retail with Amazon or Shopify, or one or two winners in social with maybe Meta and X, or, search with Google. We think that will be the same thing in the Bitcoin treasury space.
What's the difference between yours and what gives you the confidence compared to Satsuma? What's the difference?
Oh, I think we're very different. I mean, first off, we have, Adam Back and myself as co-founders started the Bitcoin Standard Treasury Company. We raised, about $5.1 billion at the time in 2 days. We're also our own largest investor. We put 25,000 Bitcoins in to seed the company. So I think, what we bring to the table is an extraordinarily deep domain expertise within the technology Bitcoin via Adam Back, and then this extraordinarily deep domain expertise within the active management of the Bitcoin treasury. So what we're really trying to do with our treasury is to actively manage that Bitcoin and use it as an asset. So much like how Berkshire Hathaway uses stocks and bonds as their asset to grow their business. And we would like to do that with Bitcoin.
Okay, we got to wrap it up there. Shamba, thank you very much for joining us.
Well, thank you for having me. Appreciate it.
Sean Bill, co-founder and CIO of BSTR. Coming up, Waste Connections reported a beat in revenue and profit for its first quarter. We'll find out what led to those results after the break. Shares of Waste Connections are soaring after reporting a beat in revenue and profit as well for its first quarter. It's up about 7.3, 7.4%. The solid waste services company CEO says it is well positioned for the full year in spite of geopolitical instability. Here to discuss this more, Noah Kaye, Managing Director and Senior Analyst covering sustainable growth and resource optimization at Oppenheimer. And Noah, thanks very much for joining us. Yeah, Ron Mittelstadt, the CEO, saying 2026 was off to a great start, and I think you agree.
Yeah, that's right. I think, going into the quarter, solid waste had generally underperformed. Some of that was unsurprising, just given market risk on. But I think there were some concerns from investors around near-term headwinds around weather and fuel. And the company was able to outperform expectations despite those headwinds. And it was really a combination of just a number of things going well. Landfill volumes picking up a bit, E&P picking up, very strong margin performance, about 20 bips above consensus, despite an incremental 20 bips drag from fuel. And then you've got the company citing, multiple trends that could support upside for the year. If we look back over the last several quarters, upside and positive estimate revisions is something the space has lacked. And so to see that starting to inflect here, it certainly reflects in the stock performance today.
How did they work around the fuel? I mean, weather you can kind of adapt to a degree, but how did they work around fuel prices?
It's very interesting the way that fuel costs and recovery work in the industry. It's typically at a lag. A lot of us will get our waste bill a couple months in advance, so it takes time to adjust for higher fuel prices. The recovery will really start to pick up in coming quarters, which will probably support revenue upside. For this quarter, it really just took better operating performance across the business. So like I mentioned, a little bit better E&P, better landfill volumes, a bit of contribution incrementally from renewable natural gas, and then the company hitting record safety performance metrics and lower voluntary turnover. That all translated to better margin performance. So it was really just execution across the board.
All right, and trends, where are some of the trends heading?
So there's a couple of things that are interesting. One, after taking a real dive late last year, recycled commodities are starting to inflect positively. Fiber is an important part of the basket for the company. That's on an uptrend. We're watching plastics as well. There's been mixed trends there, but generally improving. So that's one factor. E&P. The interesting result here was a 4% increase organically in E&P without much of an uptick really in U.S. drilling activity. You might think that in a persistently higher for longer energy price environment, we start to see some inflection in U.S. rig activity. So that could provide upside. And then certainly activity in and around construction. The company saw a nice growth profile in special waste. That's typically preceding a pickup in broader construction activity, which might start to manifest around midway through this year. So all of that kind of contributed, along with a healthy M&A pipeline, to pretty constructive commentary from the company.
All right, and how much of a factor is the fuel going to be moving forward? Is it a great, it depends?
If diesel prices are going to be where they are now for longer, you're going to see that recovery, happen over the coming quarters. The mechanisms are pretty well established for all the solid waste players. In Connection's case, they actually hedge already about 50% of their fuel. And I think there's also something of a natural hedge for the company around having relatively high E&P exposure. But if the fuel prices stay where they are, you'll just see surcharges increase over the coming quarters. And, the company was talking about, and this would be expected, that basically at the end of the year or early next year, they'll mostly be caught up on that surcharge lag.
All right, and you were in on the earnings call. Any one thing that stands out that we haven't talked about?
We talked about the M&A, pipeline increasing. I think the interesting thing, and we've talked about it a little bit before, Roger, is how AI is actually starting to materialize as a tailwind for this company. Mm-hmm. Their pricing in the quarter was at the high end of what they'd messaged, and they talked about pricing for the year being at the high end of the prior guide. And part of the reason for that is they're seeing through AI pricing tools just better pricing stickiness and customer retention. The company was also laying out a number of AI-related productivity initiatives that they think are going to structurally raise margins. So seeing some of the AI opportunities start to materialize in results and seeing some runway for that over coming years, it's going to be very interesting to track.
Okay, we got to wrap it up there, Noah, but thanks as always for joining us.
Thank you.
Noah Kaye, Managing Director and Senior Analyst covering sustainable growth and resource optimization at Oppenheimer. Still ahead, today's Market Movers with Bloomberg's Matthew Griffin. Joining us now for some movers south of the border is Bloomberg Equities reporter Matthew Griffin. Matthew, thanks as always for joining us, sir.
Roger, thanks for having me.
All right, ServiceNow taking a hit on the U.S.-Israel-Iran war, I guess is what we should call it.
Yes, so ServiceNow gave results that have badly disappointed investors. Their subscription revenue grew about 22% in their most recent quarter, but the company said that this would have been about a percentage point higher if it weren't for some major deals that were, they call them on-site deals in the Middle East that were delayed due to the conflict. That result actually about in line with what analysts were expecting, but you have a company here where sentiment was already pretty negative. The shares had slid by about a third this year due to fears of AI disruption. So there may be very little tolerance among investors for anything less than a beat and raise quarter right now. And you're seeing that negative sentiment kind of come home to roost for ServiceNow today.
And have they said how long that impact might drag on? I guess it depends on the length of the war.
Yes, so I'm not aware that ServiceNow has put that in detail, but I think it's something that the investors are watching closely across Wall Street. I mean, just yesterday you saw Sunoco, the packaging company, with a record drop in the stock here in the U.S. They said that the war was driving up some of their costs. And so this is something that investors really are laser focused on as the broader market rallies past the war. They're looking for where these pockets of weakness are.
All right, Texas Instruments next. Strong forecast. Kids are still buying scientific computers, or calculators, I guess, eh?
Well, they are.
Trying to show my age there?
When I was in high school. No, I used them when I was in high school, but the strength here actually coming from data centers and factories. Texas Instruments does not make the AI chips that are used in data centers, but they make these analog chips that are used for things such as power control. These are chips that create they switch between digital signals and things like heat, light, electricity, that kind of thing. You need those for managing factories, data center facilities, that kind of thing. So the company gave a revenue outlook for the second quarter that was better than Wall Street expected. They see $5 billion to $5.4 billion in sales. Analysts looking for less than $5 billion there. That sent the stock up as much as 20% today. That's the most in one day since 2001.
Yeah, it does feel like it's going through a bit of a renaissance, doesn't it?
Yeah, this is a stock that had pretty badly lagged, especially like 2023, 2024. And some of that had to do with manufacturing slump. You see now manufacturing activity picking up. This ISM manufacturing gauge has shown pretty strong results a few months in a row. Could be something investors are thinking about with companies that sell into that industry.
All right, we got about 30, 40 seconds. Lockheed's report, bit disappointing.
Yes, and the reasons are classified. I am not joking. It was classified programs that hit results. Revenue there shrank by more than $300 million year over year. Also some weakness in the F-16. Free cash flow turned negative. This company has reached deals to grow its missile output with the U.S. government. Right now, though, investors not seeing the results.
All right, so if you tell me, you'd have to kill me, right?
Yes, I guess, well, the company would be in legal trouble if they told us exactly what these programs were. Of course, this is a stock investors are excited about, up about 14% this year before the report, well outperforming the S&P. Today, though, investors may be wondering whether those expectations will be met.
All right, we got to wrap it up there. Always a pleasure, Matt. Thank you for joining us. Bloomberg's Matthew Griffin. That wraps up this edition of Trading Day. Have yourself a great afternoon.